Alright, hello fellow intelligent investors. My name is René Zellman, and in this video I want to explain the concept of intrinsic value. And I will explain it in such a way that even beginner investors will develop a pretty good understanding of what is meant by the intrinsic value of a stock, but also the intrinsic value of an asset in general. I'm sure that many of you have heard the term intrinsic value, but in my experience very few people really fully grasp what the term actually means. And to change that, I will use an example most everyone is familiar with, the example of owning or buying a house. And one of the goals of this video is that once you have watched the video in its entirety, you will also understand why one basically cannot invest in non-productive assets, such as paintings, watches, or Bitcoin, because such assets have no intrinsic value. And as a result, everyone investing in such assets is basically speculating. And without further ado, let's run the intro and get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, you're probably familiar with sweeping statements such as investing is like gambling and I don't gamble, or my neighbor has lost a fortune in company X and that's why I'd never invest in stocks. What about this one? The stock market is evil and you're going to lose all your money if you invest in stocks. In my view, these beliefs are often developed in childhood and unconsciously guide people's decisions for many decades. And that's quite unfortunate in my opinion. And to be fair, most people have very limited and somewhat ignorant understanding of the stock market and how it operates. To them it's just some flashing red and green lights and some prices that randomly go up on some days and down on others. Now, if you've watched some of my videos or follow me on Instagram or Twitter, you probably know that this perception couldn't be further from the truth. Of course, every investment carries some risk. However, driving a car also exposes you to a certain level of risk, and yet most people drive their cars on a daily basis. Here we can actually draw a nice analogy. When driving a car, you can increase your safety by driving a safe vehicle, by buckling your seatbelt, and by following the speed rules. And it is similar with investing, by choosing a decent investment strategy, for example, or by analyzing business fundamentals, by being a long-term investor and determining the intrinsic value of the business that you want to invest in. You can reduce your risk in the world of investing as well. And in particular, you can reduce the risk of permanent losses, because basically a permanent loss of capital is all we care about. We don't really care about short-term market fluctuations. Okay, next up we will define the term intrinsic value. But before we do that, let me know in the comments down below whether you have friends or colleagues who think the stock market is evil. When did you realize that the stock market is not evil, but actually the best place to build wealth so that you have enough money to live off in retirement? Alright, what does the term intrinsic value actually mean? Well, the term intrinsic value refers to the worth of an asset. And it should come as no surprise that a basic requirement of sound and intelligent investing is that you don't pay more for an asset than it is worth. And this immediately brings us to the next question. How do you determine the value of an asset? I always like to introduce this topic with an example that most everyone is familiar with. And I think I've picked this up from Joel Greenblatt actually, from one of his investment talks. I think almost everyone has an idea of what the process of buying a house looks like. So let's assume you're a real estate agent, and in the world of investing this is Mr. Market. Well, let's say he or she is offering you a house, and he's offering you to buy the house for $1 million. Now, how can you figure out whether this offer is a good deal or not? Because obviously nothing is worth an infinite price. So do me a favor here and pause the video. Really press the pause button and ask yourself what kind of question or what kind of questions do you have to ask a real estate agent to figure out whether his offer is a good price, or whether your real estate agent is trying to bamboozle you. Now seriously, take your time to think about this, because I think this is how you can truly understand the concept of intrinsic value. Okay, now that you have paused the video and have come up with some ideas, let's take a look at some possible questions that you might want to ask your real estate agent. Well, one question you could ask is, okay, Mr. Real Estate Agent, can you tell me how expensive this house is relative to the other houses in that street or in that neighborhood? Like, what's the price tag of the house on the other side of the street? What's the price tag of the house next to it? I mean, they also have 3 bedrooms with a fitted wardrobe or with the fitted wardrobes, 2 bathrooms, a fully equipped kitchen, living room, a dining area, and an entrance hall. So can you tell me the price of them? So basically you are asking the real estate agent whether the house offered to you is relatively cheap or relatively more expensive than similar houses in the same area. And clearly you could do the same with businesses, so with stocks, and compare prices of businesses operating in the same industry. Moreover, you could compare the housing prices of that region to historical housing prices. You could ask the real estate agent what the owner of the house, who is offering you the house for 1 million now, what did he pay for the house when he bought it 10 years ago? This is another form of being relatively cheap. And similarly, of course, you could compare stock price to its own stock price history. Now, both of these approaches are called relative valuation. And quite frankly, I think both of these strategies, so comparing the house to the price of similar houses or comparing the price of the house to its own historical price, I think both of these approaches are bad ideas. That's not how you value an asset. You cannot know whether the whole neighborhood might have been overvalued or is overvalued right now. And you wouldn't be able to identify such a bubble by only looking at other houses. And you cannot know if the owner paid way too much for the house when he bought it 10 years ago. So a house, just like a stock, may be relatively cheap, but that doesn't necessarily mean that it's absolutely cheap. If you bought the cheapest internet stock during the .com bubble in 2000, that stock wasn't cheap. For many of these stocks, the returns ever since the bubble burst have been flat. And let me stress this with a quote from Thomas Graham Kahn. He said, "We study companies and try to find undervalued securities. We're absolute value investors focusing on asset values, book value discounts, and low price to earnings ratios to normalized earnings. And we aren't interested in so-called relative values. You know, something selling at 20 times earnings in an industry group with a 35 multiple." And Alan Meacham also said, "I'm not interested in buying things because of relative value." So that was the first question, or the first set of questions you could ask a real estate agent. And here's another, and in my view, a better one. I would suggest you ask your real estate agent, if I rented that house out, how much could I charge my tenants? If you could get 100,000 a year, you would get a return of 10%. 1 million divided by 100,000. Of course, this example is a little simplified, because you'd also have to factor in capital expenditures. It's those expensive big ticket items that need to be replaced every so often, but maybe not every month or every year. Like for instance, you have to replace roofs, appliances, driveways, or plumbing systems. But for the sake of this video, let's keep it relatively simple here. Apparently, a wonderful house in a great location can be a terrible investment under certain circumstances. The best house in the best location can be a poor investment if the purchase price is significantly higher than the future rental income. For some reason, most people find it easier to value a house than a company, even though both assets have a lot in common. Both need to be purchased. Both generate cash, hopefully. Both increase in value over time, again, hopefully. And both require maintenance capital expenditures, so replacing the heating system, the roof, or in a factory, you might have to replace factory buildings or vehicles. Both need growth capital expenditures, for example, hiking rents after renovations, or again, in a firm, improving productivity by investing in new machines. So please keep in mind that shares of a stock are not random pieces of paper or lottery tickets. Just like a real estate can throw off rent, a business can generate profits and generate cash flows. Now, please pay close attention now. In order to value any asset, be it a house or a company, you need to consider the cash the asset produces. And as a result, in theory, the stock price or the price of a house should reflect the sum of all future cash flows, discounted back to present value by some reasonable rate of interest. And regardless of which asset you want to value, this core principle pretty much remains the same. This idea was first put forward by John Burr Williams in the Theory of Investment Value, which was published in 1938. And quite frankly, the concept is painfully simple, but I'd say that maybe 90% of market participants, maybe even more, don't get it or aren't aware of it. And the same can probably be said about homeowners. To explain it in the words of Christopher Beck, when I think of ownership of a business, we are basically counting cash as it is earned, which is typically when the product or service is delivered. Investing is simply the counting of all that cash and discounting that cash stream at an acceptable rate to determine what the investment is worth, and buying that stream at a discount to what it is worth. Now, when we are trying to estimate the fair value of a business, we will use a metric called free cash flow. Free cash flow simply represents the cash a company generates after accounting for cash outflows to support ongoing operations and to maintain its assets and business operations. Put differently, free cash flow is calculated by subtracting so-called capital expenditures from operating cash flow. And both of these items can be found on a company's cash flow statement. There are many aspects of valuation where we can agree to disagree. But the fact that free cash flow should be used to determine the intrinsic value of a business is not up for debate, in my opinion. Surely some people will argue that value is often fair only in the eyes of the beholder. But obviously these guys are not investors, because based on this logic, one could easily justify any price, which is absurd. Individual perceptions might matter when one is trying to assess the value of a painting or a stamp collection, but as you know, you can't invest in non-productive assets. You are speculating. Value investors do not buy stocks for aesthetic or emotional reasons. We don't buy any asset because we anticipate that there will be a greater fool who is willing to pay more than we did. Instead, we buy companies based on cash flows and the cash flows we expect to receive from the business in the future. To quote Jeffrey Ubben here, to us, an asset is only an asset if it generates free cash flow. Now, generally speaking, I prefer to invest in businesses that are drowning in cash and that can grow their cash flows over time. The legendary and brilliant David Polin from Polin Capital is quoted saying, "We are looking at companies that produce a lot of free cash flow." Kind of a simplistic analogy would be an individual earning and saving a lot of his earnings each year, putting it into a bank account or into an investment portfolio, and then finding out after a number of years that he has a serious net worth. And if we get back to our house analogy, it should be obvious now that valuation matters. No business in the world is worth an infinite price, just like a house. Imagine your real estate agent is trying to sell you a house for a cool $1,000,000, but the rental income will only be $10,000 annually. That's a pretty expensive house then. That's why I cannot stress enough how important it is to pay the right price for a business or a house, and the risk that comes with overpaying for the asset. A great business is not necessarily a great investment, because even a world-class investment can be a mediocre investment if you overpay for it. As an investor, you have to make sure that your purchase price is not too high relative to future cash flows. Alright, this brings us to the end of this video. As always, may your finances and investments prosper. Good luck and see you in the next video.